right, everybody that's joining, as I always say at the beginning of these conversations, thank you, first of all, for joining as I do these daily. My name is Michael Guyette, publisher of the Lead Lag Report. It's joining me for the hour, my friend Dan Russo, who I had on in the very beginning when Spaces was just getting started. And I'm glad that Dan's going to spend the hour here with us. So, Dan, for those who are not familiar with your background, just introduce yourself as far as who you are, how'd you get involved in markets, and what are you doing now?
Hey, yeah, Michael, thanks for doing this and thanks for having me on. It's great to be back. So, yeah, my background is I'm portfolio manager at Potomac Fund Management and also director of research. So, Potomac runs tactical ETF portfolios that are structured as strategies and that are then used by financial advisors to help their clients meet their goals. We also provide research, mostly technical research for financial advisors as well. So for the advisor community out there that is interested in kind of doing a little more of their own work, their own portfolio construction, or just getting some thoughts and ideas on the market, we have a product called Research by Potomac. So, kind of similar to yourself, right? In that you're managing money, but also come to the world as a research provider as well. And I think that provides an interesting perspective. I always think that there's a huge difference between people who do research and people who manage money. A lot of people don't think that those are two different things, but they absolutely are. And I kind of straddled both worlds for a long time. Prior to coming to Potomac, I was chief strategist working for Mark Chaikin. So for those of you who are technically inclined, you've probably heard of Mark and his Chaikin money flow indicator. And then before that, I spent over a decade on the sell side of the street covering kind of a who's who of institutional investors, mostly hedge funds in New York and Connecticut. If I put their names out there, you would have heard of them. So that has given me an interesting perspective as well, because I have a good grasp of how these large institutions kind of view the world from an investment perspective, and how quickly some of them can move, or how not quickly some of them can move when dynamics in the market change. And I had a good client base in that I covered a lot of the traditional kind of big, slow moving, long only mutual funds, as well as some of the biggest and most high profile hedge funds in the world. So those are two different worlds in the institutional community. And it's kind of interesting to see how they kind of play off of each other. So that's the background here for myself.
So my friend and colleague, Mike Venuto, would say that the only difference between research and managing money is assets. I think it's a little bit more nuanced than that. And you alluded to that point, Dan, that research and managing money, being a portfolio manager, some people think of them as one and the same, but they're actually quite different. Let's expand on that a little bit. What are the major differences, obviously, beyond managing money directly? What are the challenges of managing money versus research? Which do you find is easier and which is maybe more rewarding?
That's actually a good question. I think that they both have their challenges. I think that at a high level, research is easier. And why I say that's easier is because, and when I talk about managing money, I am talking about managing money in an institutional context, right? Where you have these guardrails within which you have to operate, things like liquidity, right? Things like position sizing, not being able to own too much of a certain sector, right? So when you start to put those guardrails around the portfolio construction process, that's what makes it more difficult, right? You might be able, as a research provider, if you're writing about, say, an ETF or a stock that looks good, whether it's from the fundamental perspective or technical perspective or some combination of the two, right? If, in my case, as being a CMT, if the chart looks good, I can write a research note and say, hey, XYZ ETF looks great. It's in an uptrend. It's above these moving averages, right? All the things that technicians talk about. And then you turn around and maybe that's a really interesting thematic ETF that has 5 million under management and trades 2,000 shares a day. Well, guess what? There's not an institution on the planet that can buy that, right? So that's, an example of where these guardrails come into play from the money management side that makes things more difficult, right? And, within the research context, right? I think, a good research provider will leave themselves out in their writing right? With the use of words like could be, may, has the potential to, right? And you can talk about levels. And if we get above this level, it's bullish. However, below it, it's not. And that's entirely different than actually having to pull the trigger, right? And put capital to work and then manage that risk. You manage, as a research provider, you manage a different kind of risk. You manage your reputational risk, right? If you're wrong enough times, right, people are going to start to say, why am I listening to this person? But when you're actually putting money to work, you're managing the capital risk, right, of losing money. And I think that makes it more difficult and also more rewarding because it is more difficult, right? If it's easy, everybody would do it. And I think it's one of the most challenging games out there, and that's what makes it rewarding.
I think that's what makes the FinTwit community so confused, right? Because you've got a lot of these influencers who have a lot of research, and people can point to times when their research was right, but you can't actually have the transparency in terms of seeing how that would translate into an actual portfolio. It just ends up being sort of this call and let's gravitate towards that soothsayer on the hill, where the actual implementation with someone like you or someone like me ends up being so transparent, which is what end people want, I would think. When you think of the FinTwit community, you have a lot of people that put out research, but you can't see the underlying performance, right? To your point, there's no guardrails. People just automatically look at calls that were right or wrong. Whereas in your world and in my world, because we're managing money, in addition to putting content and research, people often will conflate the two. So if I'm going through a drawdown as I am now, people may think that the research that I'm putting out is also not right or is losing money if you followed it, whereas that may not be the full story. Same thing with you, right? When you have that extra data point of seeing the research, it makes the standard higher for us than for those that seemingly have what looks like good research, but you have no idea how it would actually be implemented and actually translate to performance.
Yeah, I think that's a great point. I also think that it's important to remember that when you're writing research, you're writing ideally for a pretty broad audience, right? Our research by Potomac is geared towards the financial advisor community, right? So that's a broad audience. So we could be writing, right, and looking at ideas within the market that don't necessarily, right, reflect exactly what takes place within our strategies, but because research is separate from money management, we're cognizant on the research side of how broad the audience is, right? So there might be things in research that we think are interesting, but we just can't implement them, right? And that's fine, right? But so I think that's number one. I think that number two is there is a huge. I mean, the line in the sand is pulling the trigger, right? The line in the sand is saying, here's this idea. I have this idea, right? And it's one thing to put that idea on paper and then see what people's reaction is. And it's an entirely different thing to actually then size the bet and pull the trigger and then manage that risk. So, and I think that's what separates, research from research slash money management. That seems obvious, but I think that's a huge differentiator. And I would say the other thing too is, I think a lot of what gets passed off as research is not really research, but it's commentary, right? And again, that's nuanced and there's a fine line between the two, right? But, saying something to the effect of, small cap stocks are outperforming large cap stocks, so that is a risk on environment, right? That's commentary. Like, that's not research, right? There's nothing actionable in that statement. You might say that statement, somebody could write that statement, and my first reaction is, okay, that's interesting, but how do I use that to make money, right? Like, that's how my head would work. I was because I spent over a decade covering these large institutions that I covered, I'm very cognizant of what's commentary and what's an actionable idea. Because when you were talking to a hedge fund manager, somebody who's running $1 billion fund, commentary is useless to that person, right? That person wants something that's either actionable or differentiated, right? Anybody can look at a chart and say, oh, hey, look, small caps are outperforming. Great. You've added no value to that. You've added no value by pointing that out. But telling me that, small caps are outperforming and the ratio of small caps to the S&P 500, when looking at their 12-week rate of change just crossed above zero. And when that happens, small caps tend to outperform by X amount over the next 3 months. Now, that's interesting. That's research. That's a value-added comment. that goes beyond, hey, small caps are outperforming, risk on, right? So that's where the fine line is. So I think a lot of what gets passed off as research is actually commentary and not real research.
No, I think that's spot on it. And the way you can tell whether something's commentary or not is not only the action, but can you actually back test the action, right? To see
Exactly
if there's any
right.
real validity. And that's what I think is also the challenge of sort of the FinTwit community with research, which may be right based on somebody saying something in the here and now. But yes, it may have worked here, but that's an n equals one. That's a sample size of one. And it's hard to create rules around some of the things that I think people say that end up getting large followings. And your point, by the way, about, if you find something interesting from a research perspective, it doesn't mean that you can necessarily implement it in a strategy or in a fund, is really important because everyone's got a mandate.
Right. And that's the thing. I think that, you mentioned the FinTwit community, and I think it's just kind of, there's a lot of people who are new to investing. They've come to markets within the past few years that don't have the same understanding of, I'll call it market structure that we do. And by market structure, I mean funds with mandates, right? Like I've seen some people go out there and say like, hey, you'd be crazy to own growth. How could you own growth when it's underperforming? Well, if you're a growth fund manager at a place like, say, a big mutual fund complex, guess what? You have no choice but to own growth, right? So in that case, that portfolio manager is now in a situation where his or her job is to kind of lose less, right? If let's say their benchmark is, Russell 1 growth, and Russell 1 growth is down 20-30% over a year, well, then you know what? That manager is trying to be down less than 20-30%. And I think a lot of the market, right, we're eventually going to start talking about markets, right? One of the things that we've been pointing out within the research product, for advisors is that, we think investors are playing the relative game now, right? We think that, within a bear market, eventually the bear comes for everybody, right? We saw starting in, early to mid-June, energy start to roll over. It was kind of the one holdout within the space. And, we've been pounding the table, myself and, Drew Wells, who's on our team. I've been pounding the table. Investors are playing the relative game at this point. You're searching for what's less bad. But, a lot of people don't understand that, right? A growth fund manager, or you have a specific mandate. We have a specific mandate. And that's what makes, getting back to your earlier question of what's harder, managing the money or writing the research. That's just why the managing the money is harder, because you see that energy is working. You have been studying markets for a long time. You have a technical background as well as a CFA. You're watching this. You're watching energy work, and you can't do a thing about it in your funds. Right. And that's what makes it hard. And somebody who doesn't understand it is then coming to you and saying, well, Michael, why don't you own energy? To your
Right.
point.
And that's what, and you can't even respond from compliance perspective to anything related to funds on Twitter. So that becomes even more complicated. But it's interesting though, and then we'll get into markets after this. But the one thing I would think that there is a commonality most in, if you think about what's the commonality across research only versus managing money only, the commonality is people gravitate towards the hot streak, right? So there is this kind of hot hand phenomenon, which is human nature, but I think that is sort of a commonality, whether it's research or fund management. They think hot hand in one means a hot hand in another.
Yeah, I mean, look, it's performance chasing, right? And we all do it to some degree. Hopefully, some of us who are more experienced, right, recognize it sooner. But of course, it is, right? That's why mutual funds with great 3 and 5 year track records take in money, right? That's why ETFs with great track records continue to take in money. So that's always going to be the case. I think that's human nature, right?
Yeah, no, for sure. Okay, so you had mentioned earlier, so you've got the tactical mindset, tactical approach with your own approach and in terms of atomic. But for the audience here, Dan, just explain the difference between tactical and strategic, because those terms get thrown around a lot. I don't know if people really understand what that means in practice.
Yeah, you know what? I mean, listen, I think the way I think of it is I think of strategic as core allocations, right? And core allocations, again, right? This can be cut and diced so many different ways. But look, at a high level, your core allocations can be thought of as the broad asset classes, right? Equities, fixed income, commodities / currencies, but let's keep that at commodities. And if you want to call crypto an asset class, great. And then tactical to me is kind of how you move within each of those asset classes, right? So, a core, to me, a strategic portfolio would be something as simple as 60-40, right? 60% stocks, 40% bonds, right? Right? That to me would be a strategic portfolio. You sit down with your advisor and you come up with a strategic plan that is going to hopefully help you meet the goals that you set out for yourself, your family, your life, whatever that is. Retiring by the age of 50, putting your kids through school, buying a vacation home, whatever that is, right? A strategic portfolio ideally is going to help you meet those goals in conjunction with your ability to save, et cetera, right? The financial planning portion of the show. To me, tactical is how you move within that space, right? I think this year provides a great example of why tactical is important, right? Because it became clear pretty quickly that fixed income was turning into a dumpster fire. And, to just kind of adhere to, being tactical in that case might be taking that 40 that's fixed income and taking that down to maybe 30 and then reallocating that 10%, somewhere else, right? And that to me is tactical. I mean, tactical can obviously have a lot of different definitions, right? Somebody who is bobbing and weaving in and out of the market, trading could, by definition, be tactical. But the way I think about it is you have your core allocations that are going to hopefully help you reach your goals. And then tactical to me means trading around those core allocations or within them, right? What is, in a 60-40 portfolio, well, what makes up the 60, right? Is it just the S&P 500? All right, great. Not a lot of decisions to make there. Or are you trying to be a little bit tactful, within the equity bucket, right? By skirting to sectors or factors that are outperforming. So strategic is, what do you own? Asset class mind. And then tactical is, how you move within those asset classes.
Okay, and that's a good transition to the name of the space, intermarket analysis, which is something that you and I share a real passion for. You mentioned small caps relative to large caps, and I want to talk about that from a tactical perspective with equity allocation, because last I checked, when you look at Russell 2000 small caps relative to large caps, your ex-dividend pretty much back to 2002 levels, meaning that if you were in the midst of the tech wreck and you said to yourself back then in 2002, I'm not going to hold large caps because I don't want that tech exposure. I want to bet on a broad range of stocks. I want to go smaller caps that have more growth potential. You've had a lot more volatility than the S&P, and you've had the same performance as the S&P going back now 2 decades, which is utterly mind-blowing when you consider all the academic research that showed that small caps had this small cap premium effect, right? That because they're underfollowed, there's less analysts, there's more momentum, completely ended up going round trip relative to 2 decades ago. I am curious because you mentioned this idea that some people will say that small caps are risk on, or in terms of their momentum. How do you think about different market cap segmentations within equities? Do you view it as a sentiment tell? Do you view it as something to tactically position, underweight, overweight? Talk about that dynamic, because I think market cap is really important and not as frequently touched on when you think about markets.
Yeah, I mean, for me, I think it is a good sentiment indicator in terms of kind of risk on, risk off. If you want to go down the route of playing, like I always look for, I'm a markets person, right? The thought of being an economist is not appealing to me, but I think that there are messages that come from the market, right? And I'm sure you agree with me on this, right? So I think, from an economic standpoint, if you kind of want to have that story to tell, right? When you like it or not, as much as technicians, we try to say all we care about is price, and at the end of the day, I'd love to just sit here and say, well, it's going up, so I'm bullish, and it's going down, so I'm bearish, right? We recognize that we live in this world that people need that story, right? So I think the small caps are one of those things that can kind of help you build an interesting narrative within the framework of markets, right? And I view small caps from 2 perspectives. Number one, just what's their trend, and number 2 is how they're performing relative to something else. Like in your case, your question is the S&P 500, fine, right? And it's kind of amazing that they've gone nowhere for 20 years. But within that 20-year time frame, they've had bouts of outperformance, and then they've had bouts of underperformance. And what's interesting to me, right, and one of the things that I've started to pay attention to is if you look at when small caps outperformed, right, a lot of their outperformance over the past 20 years was coming out of the tech wreck, right? And, more recently, you were actually starting to see some improvements in relative strength in small caps relative to large caps, which kind of makes sense if you think about how markets are. Right. Obviously, the lower quality, higher risk names are going to start to roll over first. Right. There's this saying, they shoot the generals last. Right. So, small caps have been underperforming. Right. But we just look at, say, something like IWM relative to S&P 500. Right. They've been in a downtrend for 15 months. OK, so it stands to reason that they would bottom first. Right. If they're actually going to come around and shoot the generals last. And by generals, I mean names like NVIDIA and Apple and Microsoft and Adobe. Right. We know who they are. Right. And in that environment, you would expect to actually see small caps start to outperform. Now, over the past, call it month and a half, they actually were starting to pick their head up a little bit. And I thought that that was interesting. But over the past couple of weeks, that's kind of moderated a bit. So for me, they're from a research perspective, right? They're a sentiment standpoint. And of course, I'm going to want to then test that, right? If small caps are outperforming, well, there's things that we can test, right? Similar to the work that you've done, right? You take relative relationships and test the rate of change over certain look back periods, right? I would never just come out and say, well, small caps are outperforming, cool, risk on. No, what does that mean, right? We have readers, people who read our research, who presumably are going to make investment decisions, right? So I always tell Drew and I are always talking. We're going back and forth, and then we test it, right, and say like, hey, here's how this has tended to play out over time. And, sometimes we'll see things that are interesting that come across Twitter, and the first thing we'll do is Drew will send me a tweet, or I'll send him a tweet, and the first thing we'll do is just kind of start scripting it and testing it. And sometimes there's something really interesting there, in which case we elevate it as part of our research process. And sometimes it's absolute garbage, and you're just kind of like, okay, move on. So I look at small caps from both regards, right? Can I generate a signal from this? Or can I use it as a kind of a background from a sentiment standpoint?
Right, and the key part of that is that it tell on breadth, right? Because there's many more small cap stocks than large cap stocks. So if you see all these breadth metrics, all you have to really do ultimately is just look at small versus large, and you can get to the same conclusion.
I think that that's probably fair. Kind of like back in March when everybody was going crazy with breadth thrusts and this is it, the bottom's in, and within a few days of that, if you just looked, Russell 2000 to lag the S&P 500 once again. So I think that is a good point, right? Because there are a ton of stocks there. I also think that within small caps, you can, even within the group itself, right? The Russell 2000, as a function of holding so many stocks, is going to own a lot of garbage companies, right? The kind of the 1,000 and below. Right,
yeah, the zombie type companies, right?
Right. So something that I like to do is kind of maybe look at 2000 relative to Russell's S&P 600, right? With small cap index, but it's kind of the higher end, right? The larger names within the small cap universe, right? So there's information there, right? If the Russell 2000 is outperforming the S&P 600, right? That tells you a little something about sentiment. That tells you a little bit something about breadth and risk appetite in the marketplace. And then from there, you can kind of take that. And obviously, you can try to turn that into a signal of some kind. Now, what I think happens a lot too is people then kind of stick to that, right? People who, listen to somebody like myself, somebody like you, who say, like, we don't do anything without testing it. We want to test everything. We want to look into it. Well, then I think a lot of people then say, wow, that's interesting. I want to adopt that, right? And I think where people then start to run into trouble from a research/money management standpoint is they make that their one data point, anchor to it. And I think a lot of times, I'm sure you've seen this through the work that you've done, and certainly through the work that we've done at Potomac, myself and Drew, is a lot of technical indicators on their own. And it's only in this kind of combining them with other indicators that you can actually build, a reliable trading strategy or investment strategy that tests well over time. And I think where a lot of people run into trouble is, they say, oh, well, small caps are outperforming. That means that's bullish. And then you turn into this environment where small caps are outperforming and the S&P 500 hit, right? And that environment, you go look at a relative chart of the Russell 2000 relative to the S&P 500. It bottomed in 1990. Absolutely went on a beautiful uptrend for about 3 years, right? Maybe even for about 4 years, really, right? And in that time, the S&P 500 got hit pretty hard, right? The Qs were down over 80%, right? So I think that anchoring to one data point as part of the research process is tough, right? So everything that we do, if it's going to make its way to the money management side, it has to then fit well with the other indicators that we use on that side of the house. Something might test really well on its own, and then used in conjunction with other indicators might be awful, right? And vice versa. Something that doesn't test that great, you might be tempted to dismiss it, but as part of a broader strategy and a broader system, actually adds value, either in the form of a lower drawdown or a greater return.
It's interesting you mentioned look back earlier, right? Because you and I both know, and this is why there's nuance when you talk about indicators. It's not just about small versus large, or in my case, lumber to gold, or utilities against the market, or treasuries, long duration against intermediate, or whatever relationship you're looking at. It's the look back that you're evaluating the actual trigger on. And I often find that people, and I can somewhat understand this, they get confused when you could conceivably have an indicator that, depending on the look back period, could say one thing, but a different look back period may be another. So, for example, let's say your signal is a moving average. That's your indicator. Well, if you're above a moving average, you can argue that's risk on. If you're below a 200-day moving average, let's say 50, that could be risk off, which means you could be both risk off and risk on at the same time because you could be above the 50 but below the 200, right? And I feel like that's a nuance that's lost by a lot of people when they think about trading signals, because the look back period can result in very different conclusions.
100%. I think I say this all the time. So, in addition to my roles here at Potomac, I also teach the technical analysis class at Baruch College in New York City, right? And one of the first things that I tell my students all the time is that I say, right, unscientifically, I would say 95 disagreements in the marketplace come down to time frame, right? Because if you think about from a perspective, right, a market, a stock, we know that there are 3 different trends in the market, right? To keep it simple, there's a short-term trend, the intermediate-term trend, and the secular trend, right, or long-term trend, right? Something could be in a short-term downtrend within an intermediate-term consolidation within a secular uptrend, right? And all 3 of those states can exist at the same time, right? And somebody who is a short-term trader who's trading the downtrend might be bearish, while somebody who's a long-term investor putting money away in their 401k or their retirement account who's investing for the next 30, 40 years looks at a 50-year chart of the S&P and says, well, that's going up, right? And both of those people will be right at the same time. And both of those people will have an argument. The bearish person will say, I'm bearish. Can't you see it? It's going down. You're an idiot. And the secular person who's bullish will say, well, we'll just zoom out and see it's a big uptrend, right? So their disagreement comes down to time frame, right? Which is another way of kind of getting to your point about moving averages. So yeah, and that ultimately difference between research and actually managing money, right? Because within your mandate as a money manager, presumably there is a time frame in mind through which you're investing, right? And unless you're a day trader, right, the day to day back and forth, right? I think commodities are a great example now, right? I think that if you look at something like the Bloomberg Commodity Index, which bottomed March, April, there's a small double bottom, March, April of 2020, and then 40% advance to the upside. And past month or so, roughly about June 8th, June 10th, commodity index started to top and has rolled over. So in the short term, bearish price structure for commodities. But off that low from over 2 years ago, still an uptrend. As a matter of fact, if you look at the weekly chart of the Bloomberg Commodity Index, right, it tagged, actually slightly went through the 40-week / 200-day moving average last week, before rebounding. For people who are candlestick enthusiasts, last week's candle in the Bloomberg Commodity Index looks like a hammer, right? So that secular trend is still in place, right? Above a rising 40-week moving average is arguably a long-term uptrend. However, the 10-week moving average has actually started over. So within that time frame, the trend is down. So I think that that's a great example. So what are you doing, right? What knowing yourself as an investor or trader is really important, right? If you're a short-term trader, commodities are bearish, right? The precious metals have been bearish for a while. Industrial metals have been rolling over for 3 months, right? And energy hasn't really broken yet. It's consolidation within the short-term time frame, and the ags are breaking, right? But longer term,
yeah. And by the way, Dan, I don't know whether you seem to come in and out a tiny bit. I don't know if you're maybe in a little bit of a tough spot as far as the audio there goes. But let me reset the room in the meantime for everybody that's here for the remaining 27 minutes or so. First of all, please make sure you follow Dan Russo and go to potomacfund.com. Dan puts a lot of great analysis and research there, which we're going to get into shortly. So I'm going through some of the most recent writings, Dan, and the title of the article we put out today, looks like, was "Equities Remain Broken, but Commodities Bounce Where They Needed to." Let's talk about the word broken for a moment, because a lot of people will say that markets are broken or that a particular asset class is broken based on some chart pattern. But what does that actually mean to say that something is broken when you look at an investment?
I mean, to me, broken means the uptrend is broken. The trend is down, right? I mean, most people are long equities, right? It takes a special kind of person to be a hardcore short seller. So in the sense of coming at the world as, say, a financial advisor who is putting money to work for their clients, the trend in most equity markets is down, right? Look at baskets of ETFs, right? I think there's maybe only one or two sectors that are above their 200-day moving average within the S&P 500, right? From a factor standpoint, most factors are below their 200-day moving average, right? So to me, that's broken. I don't mean broken like not functioning, right? You can debate market structure and whether or not the market itself is broken. I don't think it is, right? You can get in and out of the market pretty quickly. The trend is broken. The uptrend is broken. We're in a clear downtrend now for fees. And, for risk assets in general, I think the commodity trade is interesting because it bounced where they needed to. And as I said earlier, the Bloomberg Commodity Index bounced from its rising 40-week moving average, right? That secular trend is there. And what's interesting about commodities is commodity cycles tend to last a time. So my of what's happening here in commodities right now, because I've seen this play out, many, many times, is that late money came to the party in the second quarter this year, and that was an opportunity for some of the early investors within the commodity space to kind of right size portfolios, take some off the table. You can picture it. I could picture it in my old days being on the institutional side, sitting on a sales desk. I can picture the conversations in May and June of this year. You're getting the call from a generalist portfolio manager asking to talk to our, say, energy analyst, right, or our materials analyst, right, and like that's always interesting because it's like, hey, you're a generalist, right, meaning you cover everything, and you're just getting to commodities now, right? They're up 140% off the low, right? What was your trigger? With the trigger, right? Well, now Russia invades the Ukraine, right? And it's just a great example of markets being discounting mechanisms. Most commodities are trading below the levels they were trading at when Russia invaded the Ukraine. So I think the secular trend is still good for commodities, but I think you probably had some money, right? Lower conviction money, if you want to call it FOMO money, come into the space, and you need to work that out now. And I think that perspective, fortunate for those investors, right? Because they're probably going to get shaken out because they were low conviction / FOMO. But in an environment where equity is not really much of a reprieve in fixed income, you probably want to be paying attention to commodities. But if you came to the commodity party second quarter of 2022, you probably just got shaken out.
Right. And there's a clear link also, usually between, just as you mentioned fixed income, there's a clear link usually between commodities and yields and bonds, right? Because to the extent that commodities are a form of cost push inflation, that should mean yields rise in the bond market until it becomes too much of a rise, in which case yields come back down, right? Kind of the cured high price is high price, cured high yield is high yield in a similar fashion. I had Walter Deemer on one of these spaces a while ago, and he had made the point that the real definition of a bear market is one where there are no green sectors. Where there's no green sectors, that's a real bear market. And this has been curious in that we've had a bear market here, but you had unbelievable strength in energy stocks. You've had relative performance in utilities, which I don't believe they're green, but they might have been earlier on a year-to-date basis. But the relative performance was so wide that it actually got you to kind of an absolute positive performance. Talk about that statement for a bit, because just your reaction to this idea that a real bear market has to have every single sector red, because if that's the case, I would argue that you have a lot more room to go on the downside broadly to undo the energy stock strength that we've seen.
Yeah, look, I think that the term bear market gets thrown around. To me, you want to define it, right? We can have the debate, right? Down 19.99% is not a bear market, but down 20% is, right? I think, Walter's comment's interesting. I don't necessarily think it has to be, where all the sectors are down. I just, it's a general trend in the market where it's difficult to make money. I would define a bear market as when you sit up and realize that if your mandate says you have to be invested, you sit up and realize that you're playing the relative game. The recognition that you're a long only manager, right? You don't have the luxury. If you don't have the luxury, say, like most mutual funds, right? Don't have the luxury of going to 100% cash, right? Maybe 5-6% cash is as high as they can go. When that manager recognizes lose less, right? If that's kind of somebody who's benched to the S&P 500, right? Because in that case, you're just trying to stick and move, right? And if the S&P is down 20 and you could be down 10 to 15, you did a great job, right? And I think that that's the environment we're operating in. So that, to me, is a bear market, right? Where you recognize you're playing the relative game, right? You're always playing the relative game. But when in your head, you're saying to yourself, I'm just trying to lose less, assuming you can't go short, right? I'm talking about a long-only manager who doesn't have the luxury of going to cash and is not, running a long-short book.
Yeah, no, I think that's a good way to frame it, right? Because it's like you lose hope that you're going to actually make money. So you simply come to terms with the idea that you will lose, but winning is losing less, and that's kind of the
which again gets to why managing money is hard, right?
Right.
Which is why an individual investor, right? Peter Lynch, right? For anyone who's not read Peter Lynch's One Up on Wall Street, it's an old book, but Peter Lynch describes this phenomena where the individual investor actually has it much easier. Investor, because number one, you don't have all eyes on you. Number two, you're probably not going to fire yourself. And number three, you have these luxuries that, a long-only mutual fund manager, which is what Peter was, does not have, right? So take somebody, I'm not going to pick on Kathy Wood. I'm going to use her as an example. I am sure that there are companies out there that she knows are garbage and would love to short, even within her space. Even if she loves her names, There are probably others that she thinks are awful and would love to short, but she probably can't, right? It's probably not within her mandate. She runs a long only fund, right? So that's where it becomes a lot more difficult. Being a money manager becomes a lot more difficult as you operate within these mandates, whereas individual investors don't have those mandates, right? You want to be short? Be short. You want to, own deep out of the money puts on the S&P 500? Cool. You can do that, right? Where not everybody can. So when I talk about a bear market, I'm saying you're a long only manager. Maybe you can go like 5% cash and you say to yourself, I'm just trying to lose less. That's a bear market.
Right. And that hits a little bit on the point that I always reference, which is that it's not just signal, it's not just look back here like we talked about earlier, but it is also the opportunity set how to lose less. So the great frustration for me, which I've said many times over, is my hell this year, which may be ending, maybe over, I don't know yet, with hindsight, is that in my world, the losing less is supposed to be going long treasuries, not going into cash, not going into utilities, not going into staples. In my world, it's long duration treasuries because, as I showed in the pinned tweet, right, when you have these drawdowns in equities, in the midst of those drawdowns, time and time again, long duration treasuries in that sequence are a better way of losing less or even maybe making money because the spread relative performance ends up being pretty wide when you're in those kind of periods. This year has been unequivocally an anomaly, and that is my mandate. I can't do anything except go through that pain and that frustration until the relation of treasuries to stocks kind of normalizes a bit, whatever that term actually ends up meaning in practice. But it goes to your point that there are so many nuances to running money, especially when you have a mandate, that it becomes very easy for people to just look to the right of the equal sign and say, look at how your strategy is doing, when they're not considering the research behind it, the rules behind it, the mandate behind it, the signals behind it, all these other things which actually go into what happens to the left of the equal sign.
Yeah, I agree with that. Number one. Number two is, I understand, right? You and I have been friends for a long time. I've obviously read your work, and like I said, we test everything. So, we've put that concept through our testing process, and it adds value, right? This concept of adding treasuries as a risk-off asset, right? So when your signals tell you our signals here are different than yours, and I can't talk specifically about our strategies, but I can say that from a big picture standpoint, we've tested this concept of adding treasuries as a risk-off asset to add value, and it generally does add value. Now, what we have not been able to get our heads around is something that we're exploring at Potomac in terms of a regime shift, and the regime shift being what happens if that zigzag correlation between stocks and treasuries that we've lived with, I call it since 1998, some people call it since 2000, where stocks and treasuries have generally moved inversely to each other, right? What happens if we shift regime prior to 1998? Now, people might ask why 1998. To me, 1998 is kind of the start of the disinflationary environment caused by bailouts when long-term capital management got its bailout. Prior to that,
and by the way, to your point about that point, so if you look at, I'm sharing the nest at the top here, but it's a valid point because if you look at the way treasuries behaved in drawdowns post 98, you would see, because of this disinflation cycle, you'd see money being made in long duration treasuries. You can see the purple, which is treasuries actually generating absolute returns, as opposed to before that, where the relative performance was down less, but down a lot less.
Exactly. So the question becomes, again, one of relative performance versus actually generating returns. And that to me is contingent on the regime shift, right? And what's different, right? What we're going to see. If inflation is persistent, I think we could be shifting into an environment where rather than your risk-off asset actually producing positive absolute returns, maybe it does become a relative game, right? Where running a diversified portfolio is simply a function of if things going down, you're going to be happy that you have something that's going down less because your overall portfolio is going to go down less. Now, the thing with that is we've had it the other way around. We've had this environment for most people listening to this, myself, you, right? We're kind of around the same age. Right? This has been our entire career. In our entire career, you've had this zigzag relationship between stocks and bonds, where you've actually gotten absolute returns out of the market in times of drawdown within the equity landscape, right? So most people don't know anything else, right? You're talking 24 years. Almost 24 years. I believe long-term capital blew up in like October of 1998. An entire career for most of us of the market behaving one way. So there's this kind of built up institutional knowledge that may have to unwind if we are shifting into a regime that existed prior to the bailout of long-term capital management. And obviously the trigger there is inflation, right? So to me, we were talking earlier, stocks, commodities, right? I think commodities are your tell here, right? Because I think that there's no question that I'm not an economist, as I said, but like if we pay attention to market relations, right, I would argue that your lumber gold relationship allows you to be an economist, right? copper gold. We have something that we call
it's about housing in the case of lumber, right?
Housing, right? We have something that we call the RBP regime index, right? Which takes intermarket relationships from equities, fixed income, and commodities, combine them into one indicator, right? And that went negative from a trend perspective in February, right? So there's no doubt in my mind that things are slowing down. People are going to point to the jobs report on Friday. Jobs are a lagging indicator. There's no doubt that the Fed is hiking into a slowdown. I think what has to be figured out for investors is what it will accompany that slowdown. Is that slowdown going to be accompanied by still rising inflation, in which case we have this stagflationary 70s type environment, or is it going to be accompanied by inflation rolling over, right, which creates a different dynamic? If inflation is rolling over, you're probably looking at like the 2018 to 2020 playbook, where you have a growth slowdown and rates are able to actually go down, right? So rates are coming, in which case, your long duration treasuries will probably start to work, and your growth themes within the equity market, right, will probably start to work. Now, I'm convinced that we had a bear market from 2000 to 2020. If you looked at anything other than the NASDAQ 100 and the S&P 500, right? Look at small caps, look at most foreign markets, right? There was a bear market in equities. It was slowing economic growth and lower rates, right, which allowed the to work, right, in the NASDAQ 100. But if we're slowing economic growth and higher inflation, right, now we're going to CPI print this week. I'm not going to try to handicap it. Estimate is for a 9 handle. Okay. But if the inflation trend is going to continue higher, then the Fed is going to have to keep its foot on the throat of rates here to try to get it under control. Rates are going to start to go higher, continue to go higher. I think that's a tough environment for fixed income products, and you probably it ends up being a tougher environment for the growth type trade as well.
And by the way, that point about the losing less with treasuries pre-98 in those equity drawdowns, it's important to note that that's still okay, right? Because if you lose a lot less being in treasuries while equities are going down, now you got more capital to compound off of to buy back into or reweight back to equities at lower prices, right?
Well, I think that you have a tweet somewhere that kind of alludes to this fact without actually saying it. It's the simple math of compounding, right? If you lose 50%, you got to make 100% to get back to even. Right. But if you lose 25%, you have to make about a third, right? You have to make about 33% to get back to even, right? And if you can continuously lose less than the overall market, you should compound at a higher rate over time. Now, lose less and over time are the keywords there that people get wrong, right? Because people see you lose, right? If you're down money, right? People don't like to lose, right? So people just see the minus sign, whether it's for their own account, whether it's for a manager to whom they've allocated. But what people don't recognize within this market, or within market, is that if a manager was down 10 when his or her bench was down 20, that manager did a phenomenal job, right? You see a loss of 10%, but that manager did a phenomenal job, right? Because if you stick with that strategy, right, if you assume that, to me, the long-term outperformance is not a function of crushing the market up. It's a function of losing less.
Which is funny because you're saying, because people now make fun of that line I keep saying in promoting the lead lag report: to kill it in the stock market, you have to not get killed. And I'll invariably have somebody.
It's just math.
No, it's unequivocal. But as a treasury drawdown this year has been as large as the equity drawdown this year. So I get it. People confuse it. They say, how can it be that you were risk on, risk off when equities have done what they've done? I thought you're supposed to mitigate the downside for stocks, but what we've seen here this year is so abnormal in the interaction of treasuries to stocks that they think that saying doesn't mean anything, but it's still valid over time. And to your credit, that's the key term there. Over time, if you can avoid those big declines in stocks, and big declines tend to happen more in stocks than treasuries, you're going to come
exactly. But we don't live in an overtime world, right?
Right.
We live in a soundbite world. We live in a 280 character world, and that's unfortunate because investing's hard, right? And everybody kind of wants the just tell me what to do. I want to do 15 minutes worth of research from 9 to 15 every morning, pull the trigger on some trades and be done with it. And that's just, I don't know. That's just not how it works. I mean, it's just not how it works. Investing's hard. The key, right? It doesn't matter. It's simple math that avoiding the blow-ups is what allows you to outperform over time. It's just,
right. And to your point, and that's on the line I always say, it's like the best way to avoid a drawdown is after one's already taken place.
Yeah.
I mean, by definition, right? I mean, that's just, and I think people have a hard time intellectualizing that because they see a chart and they don't understand that that's the very definition of buy low, sell highs after a big decline. And that's not just for strategies, but just for any asset class as a general rule. But I want to go back real quick, Dan, to something you said before about, you said you're kind of struggling with this issue of, are we in a regime shift? And you use the word if, right, which is a research word, right?
It is a research word.
It's like you never go back to research versus portfolio management. So the if is what's challenging here, because it's not clear, at least to me, that the disinflation longer term dynamics have gone away, right? It's like I keep making this point that the focus on the word transitory was, to me, very misguided throughout this whole period, because nobody defined what transitory really was in terms of time, right? It's short term. Well, I can make a case that 3 years could be short term in the context of long cycles, right? 3 years of inflation could still be transitory, even though it doesn't feel like it, right? So let's hit on that identification. How do you never really know with hindsight if a regime has changed, if a cycle has changed, but there are certain tells, right? What are some of the tells that you think are worth paying attention to that would suggest that this is a new world, or maybe that this is just a blip?
I mean, for me, like, the tells are always going to be market related, right? So if you want to just take if you want to take rates, right, the 10-year kind of knocking on 3.2%. If you get above that level, right, to me that would be indicative of the regime shift, right? Commodities, right, would be another example, right? When I say commodities bounce where they needed to, okay, great. That long-term trend is up. So if we get some follow through there and commodities continue to, move to the upside, right, with positive absolute momentum, they certainly have positive relative momentum. With positive absolute momentum, you have to say, okay, this is a regime shift. This is something different that's more inflationary than what we've seen over the past 25 years. So for me, for us at Potomac, right? I mean, if you look at our tagline on our website, like, it says right there, we're built to conquer risk, right? So we always recognize that we could be wrong. So obviously management would have to start to come into play, right? If we have a view and it's not panning out, right? So what would tell me my view is not panning out? Well, if rates continue to run lower, as they have over the past kind of month, 3 weeks. If oil, say, like, if I'm looking at a chart of crude oil now, and it's just fascinating to me that we're, only a few bucks higher than where we were when Russia invaded the Ukraine, right? So to me, something like crude oil breaking $90, you'd have to reevaluate your inflationary view, right? Maybe not so much the ags, right? Because there's these idiosyncrasies within the ag space, but, everything for us would be market-based. There's always a price that says you're wrong. I don't do dogma. As a matter of fact, it drives me nuts. We can talk about Bitcoin another time. I don't do dogma. There's always a price that says you're wrong. So it's always going to be some market-based tell that says, you know what, Dan, this view you have is wrong.
Right. And that's why, price matters more than narrative, right? Because narrative is...
Of course it does. The narrative in February was Russia invaded the Ukraine. Right. Commodities are going to rip. You know what that did? That served to get all the generalists in, right? That got the people who missed the first 120% off the low said, oh, wow, look at these things called these. It's like, where have you been? And that's, that.
And that's what's so brutal about the FinTwit community, because you can see that not just with energy or in commodities. You saw it with Bitcoin, okay, around the narratives around store of value, which I kept on maybe overdoing it in terms of kind of poking fun at the nonsense of what the definition of that is, right? Some people will maybe throw back at me, maybe justifiably so, that I kind of committed the same error with the black swan definition, although I would still counter Taleb in the characterization of it. But he's the guy who came up with this. Who am I to say anything? But that it's you have to ultimately be humble enough to realize that the stories that we're told are probably not real.
They're probably not real, or they're probably not going to play out to the extent that you think they will, right?
Exactly.
I think the best investors, right? Look, I spent 10 years on the sell side. Most of the investors that I covered were fundamental, right? They would build a fundamental thesis. They would do the fundamental work. The best ones to a person were not the best stock pickers. They were the best stock sellers. They were the ones who would recognize that the narrative had changed or that their thesis was wrong and not dig their heels in, dogma, but just get out of the way, reevaluate, reassess, and then decide whether she or he would want to get back in. The best clients from a performance standpoint, the best investors that I had over 10 years of covering some of the biggest funds on the street were the best sellers of stocks. They did not become dogmatic. They did not dig in. No, it wasn't if you loved it at 6,000, you gotta love it 3 times as much as 20,000. No, this was bullish at 60,000, going through 50,000, something's changed. I'm getting out of the way. You know what I'm talking about. But they did that with stocks, right? So the people who were least dogmatic were the best investors, right? Which gets back to manage risk, and there's always a price that says you're wrong.
Right, and it goes back to research versus managing money. So we've gone round trip on that conversation. So everybody that's here, please again make sure you follow Dan Russo. I put a tweet out with a link to find some of his research at potomacfund.com. Dan, you and I think very similarly, and I love the way that you educate in the way that you communicate, because I think the entire FinTwit community needs to hear people like you who have seen both sides, lived both sides of the research and managing money side, and also recognize that humility is perhaps the one thing you should you should really bet on if you want to stay in the game long enough.
I think that's right. I think that it's a fine line when you're an investor, because you have to have enough of an ego to think that you're right. Right. I mean, think about what it means to put money to work in the market. You're telling the market that it's wrong about something, right? That you think the price should be higher, right? So that does take conviction. That takes some level of ego, but not so much ego that you don't have enough humility to say, I'm not right here. I'm going to get out of cess and move on.
Yeah, no, very, very well said. Thank you everybody for joining.